I'll talk about some of the trends in the global energy system. And broadly speaking, what I'll be arguing is that it's at a transition point. Energy is really complicated. Everything is connected to everything else, and it's hard to see exactly what's happening. So I'm going to be arguing that there's a shift, a transformation of the energy system. I've actually been arguing that for 10 years since starting New Energy Finance. And that there is a shift from this kind of centralized, mainly fossil-based, not very intelligent, geopolitically exposed, non-resilient system to something that is more distributed, cleaner, embodies more intelligence, and so on. And that's really the thesis on which I set up New Energy Finance. But I'm going to argue that that transition, first of all, that it's happening, but also that it's non-linear, and that we're at a point when the transition seems to be accelerating. So this concept of a phase change, at heart I'm a geek. Phase change, a change in a feature or physical system results in a discrete transition, and this is the sort of thing we're talking about. That we're not talking about just a change at the margins of the energy system, but we're talking about a phase change to something new that will be recognizably new and different. But we start with the money. This is something we've been tracking right since the beginning. It's the flow of money into something that we broadly call clean energy. For the purposes of these statistics, it's renewable energy, it's energy efficiency, it's power storage, electric vehicles, carbon capture and storage, but discrete investments that we can track. There's lots of stuff goes on, particularly in energy efficiency, that we don't see and isn't in these numbers. It also, just for reasons of getting a nice clean signal, it doesn't include nuclear, natural gas, or large-scale hydro, for historical reasons, the latter. But you do get a nice sense of what's happening. Is more money flowing in or less? And also what's the order of magnitude. So 2004, when I started New Energy Finance, as it then was, it was about 50 billion. It then soared. There was a moment, there was a big wobble when I sold the company to Bloomberg. You know, I'm taking credit for this increase in investment flow, of course. But really, this was just these were the glory years when everybody got excited about climate, about clean energy. Remember, it was before Copenhagen, and then you had both the disappointment of Copenhagen and the financial crisis, so the money went flat. And then it took off again. Many of you will remember green stimulus, this idea that, that one should stimulate the economy, but at the same time accelerate a shift to clean energy and other sustainable solutions. So the money continued to flow. 2011, a peak at $300 billion. That's nearly $1/3 trillion. And during this period, we've seen more than $1 trillion invested in clean energy. So just order of magnitude, you start to say, well, this is not trivial, this is not nothing. And so there's definitely large volumes of money that have been put to work in this sector. But in the last 2 years, you can see that it's dropped away. And the question is why and how significant is that? It's not just the money that's dropped away, this is now gigawatts. So this is physical plant producing electricity. And throughout this period, it just went up and up and up. So there was always more renewable energy on the system. And then in the last year, and I think this is just large projects, not including big hydro, but you can see in the final year there, it actually dropped. So this is quite a negative picture of an industry going through a sort of boom-bust cycle of some sort. If you go around the world, you can see in America there, the investment grew very quickly. In 2004, this is typical of America. The capital markets are extremely well connected. And so when American investors decide clean energy is the next big thing, investment goes from 12 billion to nearly 50 billion in just 4 years. Incredible acceleration. This is what the American capital markets can do. But of course, when Lehman goes bankrupt, they also go into reverse quickly. They're volatile. They go on and they go off. And there's also a political cycle. Some of the tax credits which they use to drive uptake of clean energy have been expiring every 2 years and being prolonged, and then expiring and then being prolonged. And you can see this in this kind of on again, off again flows of money. Central South America, two of the smaller markets, Central America, it was actually Latin America there. Brazil did lots of ethanol for its transport fuel. In 2006, 2007, there was a lot of money flowing, up to $15–16 billion. What's happened is that has fallen away with Brazil's economic problems. But what we now see is solar, we see wind, we see biogasification, and we also see other countries coming in, Mexico, Chile, and so on. So this is now no longer just a Brazilian story. And over here, Middle East and Africa, a market that was essentially dead until really very recently, the last couple of years, suddenly $10–11 billion a year being invested. A lot of it South Africa, some of it Kenya, some of it Morocco. So what we're seeing is this kind of spread into some new countries and regions. Asia is the extraordinary story. It starts from very low levels, 17 billion back in 2004, but that then soars, and in fact it's now the leading region for investment in clean energy. China alone investing $65 billion, but it's not just China. You can see the total, I don't know if you can read it, 120, it's about half of it is China. Japan, post-Fukushima, India, even countries like Thailand, actually seeing a reasonably large and growing level of investment in clean energy. And then the real sort of problem child is, of course, Europe. Europe was the first region to do large-scale investment in renewable energy, and it actually rode through the first fiscal crisis, the first part of the crisis, 2008, 2009, with the help of green stimulus programs, particularly solar rooftop programs. It was seen as a good way of getting money out into the community, stimulating lots of activity. So we saw Germany, we saw Italy, and so on. Spain actually did a lot in 2008. But if you look at 2010-11, a lot of that was actually German rooftops. And then the last 2 years, a real collapse in investment activity in Europe. That's it. That's Europe on a quarterly basis. You can see that it still has not recovered. You know, the peak quarter, $33.5 billion invested, obviously in euros, but translated to dollars. And there you can see quarter by quarter, it's actually still headed down and not headed up. Now, one of the reasons was the saturation of the German rooftop market, but this is the other main reason. Investors hate uncertainty. Uncertainty is Ebola for investors. And what you've seen is starting with Spain, but then spreading to Romania, Bulgaria, Italy, even Belgium, retroactively changing the rules. So you're building a project, you do the economics, you build your spreadsheet, you work out it's going to produce an acceptable return, you manage your risks, you take it to your investment committee, they approve it, and then a year or two later, the government turns around and said, well, you know, we were going to pay you this for producing clean energy. Actually, we've changed our mind. This is essentially no different from sovereign default, except that because the only people who lost out were clean energy investors, nobody seemed to mind, and therefore this spread across the red countries you can see there. It's not just a question of retroactive changes. There's also a permanent process of policy review. Because the costs are evolving so rapidly, because countries' fiscal situations were evolving so rapidly, just country after country has been reviewing its energy policy, the support for clean energy in particular. And so you see France, actually some of the uncertainty in France is finally coming to an end, but the UK, Germany, Portugal, Poland, it's just very, very difficult to finance projects or businesses in those sorts of environments. And investors have choices. They decide effectively to do other things, other industries, other countries. Oops. Don't know if I can go back. I don't know if I really need to. Hang on. There we go. Right, let's try that again. And so what we see as the European market, not even stuttered, but really fell over, what we saw is an enormous consolidation wave. Those were companies that went out of business, most of them in solar, over the last few years. It's by no means a comprehensive set of logos. We just got bored of adding logos at a certain point. Literally hundreds of companies out of business. In the wind sector, there was a consolidation. Companies didn't tend to go out of business, but what they did is they shut manufacturing and assembly plants. They had to cut costs very dramatically and size their operations to meet what was happening in the markets. We publish an index, a stock market index called the NEX. There's 106 constituents. It shows the market valuation of clean energy companies right across the value chain. You've got technology providers, you have green utilities, you've got small companies, you've got bigger ones. It's a very clever methodology, but that's what it's done. So over the last 4 years, since January 2011 rather, that is the New Energy Index, the NEX, and now those are the two, that's the NASDAQ and the S&P 500, the two biggest stock market indices that are dollar denominated. And you can see that if you'd have put your money into the stock market as a whole, you'd now be sitting on 60% gains over that period. If you'd have put it into the NEX, you'd have had an extremely scary ride and you'd be back where you started. So this is a very difficult environment for investors to operate in, this level. And if you go back before 2011, you had this sort of huge boom and the ramp up, and then you had a crash. And so it's not only have you had poor returns, but it's also volatile. It's also scary. It's a scary ride. So this is a very negative last few years: consolidation, lack of value creation, companies going out of business, and investment volumes dropping. So it's sort of hard. I'm an optimistic chap, and I think my role to a certain extent in the industry is to say, don't worry, it'll all get better. But I really do believe we are at a point where it is indeed already getting better. The nadir was this story in the US where the CNBC ran this thing called the clean tech crash, which was the 5th of January this year, where they decided that clean tech was dead and made a big program about it. And of course, what happened was about a week later, Google bought Nest. Nest is a thermostat and energy efficiency play for $3.2 billion. And in fact, what had been happening, if you look at the NEX, from the beginning of 13, not the beginning of 2011, but the beginning of 2013, you'd see that the NEX had actually gone up 60%. So had they run that story in 2012, in fact in July 2012 was the low point, then perhaps it would have been a good piece of journalism. But the fact is they got it out by a year and a half, and in fact the market had already begun to recover. And the reason is that the public markets had spotted that consolidation had actually run its course. The wind industry was in much better shape. The solar industry had also cut out a lot of these weaker players, and there was both a supply side and a demand side to the clean energy industry that were broadly balanced and in good health, and hence the NEX index had returned and was interesting. The sector is in much better health this year. Underlying that health is a concept which is, it's almost a religion to my team, but also to people who follow the clean energy sector, which is the experience curve. What you see there, this is actually crystalline silicon on the top and amorphous on the bottom, so two different types of technologies for solar photovoltaics. And you can see there, what's interesting is these are actually the price, not the cost, of modules, so the finished product. Now the price follows not just the costs, of course, but also market pressures. And what you can see, the most interesting time is here, where you can see 2003 to 2008, the prices stay flat. And the reason is those are the years when there was so much demand being added. There was policy after policy, Germany, Spain, California, Italy, even the UK. And there was not enough supply. Silicon has to be refined to a very high level of purity. Takes a while to build silicon refining capacity. And so the demand outstripped the supply for a period, and prices obviously stayed high. So you had this bizarre situation where policymakers were instituting feed-in tariffs, and of course they were asking industry, directly or indirectly, what price do we need to give for you to build solar? And the answer was entirely circular, because there was no silicon. So essentially what was happening was the price was staying where it was. The price was being set by the tariff, not by anything related to costs. Of course, what happens is that when that flips, when investment on the supply side comes through, then the pricing regime flips completely. So it then becomes much more related to costs again, and you see that it returns to the long-term experience curve, which you can see there. And by 2011 and now, enormous drops, and very rapid drops. So the drop was much more rapid than the experience curve cost reduction because of this pricing behavior. But essentially what you saw then is since 1976, solar has gone down by 99% in cost. And even over the last 4 or 5 years, it's gone down by 80–85%. Very rapid drops. And the point about an experience curve is it never stops. It never stops, because the cost reductions are proportional to the cumulative experience in the industry. So they slow down because you stop doubling your experience as quickly, but they essentially go on forever. So to anybody who asks whether we can have lower cost solar than we have now, the answer is absolutely. In just the same way that we have lower cost flat screen TVs and lower cost pretty much every other manufactured good, it will not be different. And when it comes to wind, wind also has a strong experience curve. The turbine prices don't come down nearly as fast as solar for a couple of reasons. One, big chunks of them are heavy engineering, lots of steel, lots of concrete. Big generators, so the cumulative experience in those industries, it goes back a long way. But also, if you look at the what the industry is actually doing is every time it doubles in experience, the turbine price comes down 7%, which is relatively modest. But the turbine output goes up as well by another 7%. So every time the industry doubles in experience, what you see is the costs coming down actually by 14%, which is quite a strong experience curve. Again, these are prices, but what you can see there is that over time, wind energy becoming cheaper and cheaper, 26% drop since 2009. And if you go back to the drop in investment where I started, a sort of 20% cumulative drop over 2 years in investment activity, the bulk of it actually comes from the price impact. The fact is that a utility that has decided to do a gigawatt of wind thought they were going to have to spend X, and actually they're spending 80% of it because it's simply become cheaper. Same with solar. Now, there is also a volume impact because projects are being cancelled, particularly in Southern Europe and so on, but the bulk of the volume of investment that has dropped has been due to the price factor. Now, where we are on the costs is this. You've got here, I don't expect you to be able to read it, and these charts will be available, but what you can see down here is a bunch of conventional technologies. Natural gas, coal, CHP, nuclear, with dots for different parts of the world. And up here you can see the clean energy, electricity generating technologies. And in the middle is a band in green, where clean energy can be absolutely competitive with the alternatives without subsidies. These are levelized costs, in other words, pre-subsidies. And there's lots of assumptions. The main one is that you can use every kilowatt hour of output, that you don't get curtailed, that when the wind blows, you use that electricity. It also doesn't include externalities like the cost of intermittency. When the wind doesn't blow, what do? You need some sort of backup. But nor does it include externalities the other way. When you use coal, you also pollute your cities. When you use oil, you have to go and patrol the Gulf and spend money on defense. So this is a sort of pre-externality, pre-subsidy picture, and you can see that clean energy pokes out here at the bottom of this sort of competitiveness band. It actually can be pretty cheap. How cheap? Well, The cheapest photovoltaics that we know about is 8 cents per kilowatt hour, $80 per megawatt hour. We see that in very sunny countries, so places like Chile, where you also have a relatively low cost of capital. The lowest cost wind, $37 per megawatt hour, 3.7 cents per kilowatt hour. I'm sorry, we do everything in dollars, but to translate it, that's 2.5p in the UK. Just remember that we're in the process of contracting 3.6 gigawatts of nuclear at £92.50 per megawatt, which is about $140, and wind onshore can be as low as $37. And by the way, you don't pay for 35 years for wind. These, in the UK system, I think wind is 15 years and nuclear is 35. Now, I'm a nuclear engineer. I'm pro-nuclear. I'm just trying to point out here the economics. Now, that doesn't mean every onshore wind farm produces for $37 for 2.5p per kilowatt hour unsubsidized. You have to have very good wind. You have to have a very low cost of capital. You have to have a very good engineering culture to provide next day or same day maintenance if something goes wrong. And you have to be able to feed this energy into the grid and use it. So you have to have what's known as a stiff grid to be able to move all of that energy around so that somewhere a consumer can benefit from that cheap electricity. You also have to have a planning process which is not so difficult for developers that they give up or that it takes years to get projects through it, because all of those delays cost money and drive up the cost of the project. And that's a veiled message also to any UK policymakers, that you have to really want to do this and you have to do it right, and you can have low-cost onshore wind. Just some other things. I mean, we've probably got offshore for those that are interested. You've got, hang on a second, wind offshore is up here at the sort of 20 cents per kilowatt hour, so 15 pence per kilowatt hour. Offshore wind is expensive, and that's a big part of the UK's clean energy mix in the future. And obviously it'll come down, experience curve, etc., but it will remain an expensive resource. So I'll return to my main argument that we are at some sort of a turning point. There is the NEX index. This is now the last couple of years, January 2013. Let's look at the sort of big picture of this comparison between clean and alternative, or the older, more conventional energy sources. And I find this absolutely fascinating. This is, in blue at the bottom is the coal, stock market index for coal, and in red at the top is the NEX. So what you've seen over the last 2 years is a transfer of value from the coal industry to the clean energy industry. Unnoticed, as I say, by CNBC and the mainstream commentators. Just out of interest, this is oil and gas. Here you can hardly see, and that one is utilities. Utilities have had a very torrid time, actually a little bit before this period. We'll come back to the fate of utilities in this world. And of course, oil, most likely, it looks like, is going to have a torrid time, what with the lower oil price because of Chinese slowdown and Russian adventures and all sorts. And of course, OPEC's response to open the spigots. So let's do a little tour of the world, have a look at how this is playing out. This is the US. Here you can see wind power purchase agreements. PPA stands for Power Purchase Agreement. It's the way that their utilities, the way their clean energy system works is that the utility tenders for a certain amount of wind power or renewable energy. They essentially are generally allowed to do that by their regulator, who says, yes, we agree there's a need for more capacity, go and buy some wind power. They then buy it as cheaply as possible, and then they're allowed to pass the costs on in their tariff. As cheaply as possible in the case of wind is as low as 2 cents. So what you've got is wind being generated at 3.7 cents, perhaps in the Great Plains, somewhere, or in Texas, and then there's a subsidy as well, there's a tax rebate, which means that developers can profitably sell wind to utilities at 2 cents per kilowatt hour. This is the cheapest form of electricity for a utility to buy, and pretty much anywhere in the world. and needless to say, utilities quite like it. Solar, same thing. We've seen it's being produced for 8 cents levelized cost per kilowatt hour, $80, but it's being sold after the subsidy here as low as $50 or 5 cents per kilowatt hour. And again, it's not as low as wind, but when gas costs 6 or 7 cents and might be volatile, might expose you to commodity risk, you kind of want some of this in your generating portfolio if you can buy it at those prices. On the rooftop in the US, the big boom, these are all fundraisings by companies that are providing third-party finance. They're knocking on doors and saying, would you like to reduce your electricity bill? And the homeowner says, how are you going to do that? And they say, don't worry, we're on it. All we need is access to your roof. And essentially what they're doing is they take the tax rebate and they provide the homeowner cheaper electricity. There are variants on that model, but you can see that some of these companies, Solar City, which is the one that's chaired by Elon Musk, who also chairs, founder and chairman of Tesla, raised a few billion, and this is becoming big business. Obviously, also going on in the States is the gas boom, shale gas, and we've seen this enormous increase in extraction of gas domestically in the US. This is just shale gas. It's shale gas. There's some experimental stuff early on, then you see the huge boom. And what's fascinating is that if you actually take out the 2 best fields, what you get is that, which is sort of an odd-looking boom. And the reason is that there's so much of this stuff that it has driven gas prices down to points where most of these fields are not profitable if they just produce gas. So fields that produce oil or liquids, rather, are able to be profitable, but when the price gets so low, then others are not. And so what you see is that the 2 fields at the top, the Marcellus and Eagle Ford, are doing well, and the others are actually struggling. Now, what's happened, of course, is the gas price has gone up, because obviously if companies have been losing a lot of money in the last few years. They've stopped fracking for pure gas. They continue to frack for oil. And what will be very interesting will be to see the impact now, what happens now that the oil price has reduced. So with oil at $75, our calculation is that there are 19 plays in the US which are no longer profitable. And the difference between shale, unconventional oil and gas, is that if you stop fracking, it stops coming out. Unlike conventional, where if you stop drilling, it'll still come out. So in a few years, if companies stop fracking, then the volume of oil and particularly gas will drop, and the prices should actually come up. In the energy space in the US, the other big story is, of course, falling imports of oil. And this is one of the things that has driven the Saudis to say, right, we're going to let the price drop because we need to stop. The cause of this is, of course, increase in oil production from unconventional sources. And this is a narrative that you see discussed in The Economist and in the Financial Times and no doubt elsewhere. And the connection between the two is always taken as a given. US imports have dropped because of unconventional oil. And you see variants of this, by the way, in the discussion of the Ukraine. You know, what do we do about the Ukraine and its dependence on Russian gas? And clearly, what we want is some of this lovely surging production. So we should either frack in Europe or import from the US. But if you scratch under the surface, there's actually something else going on which is more significant. If you look at the fuel efficiency of American cars, what you find is over the last, this is actually, it's 8 years, an increase of 10% in fuel efficiency. That's not new cars, this is cars in use. And new cars, the improvement has actually been 25% over that period. So there you've got 10%. So like for like, cars are using 10% less fuel. But also, Americans are driving less. So this is, if you look at the long-term vehicle miles driven per person, it's gone up and up and up. This is the American dream. What do? You get wealthy, you get a big inefficient car, and you drive it more and more every year. And then something happens around 2005-06, which is it starts to drop. And initially it was very difficult to know, is this just an artifact of the recession? Is this just an artifact of the fact that that oil prices are now high? Will it bounce back when either the economy starts to grow or the oil price drops? Well, first thing we can see is that it's not just the recession, because the US economy returns to growth in this period here, and yet the miles driven don't start to grow again. We'll see what happens if the oil price meaningfully drops. We'll see whether the elasticity means that people start driving more. But this feels like a series break. And there are behavioral, anecdotal, and some academic studies that show that millennials just aren't as interested in cars as their parents. And you get stories about people who they're quite happy just not to have a car aged 20, which would have been effectively aberrant behavior 15 or 20 years ago. And it seems like some segment of American millennials, American kids, would rather have a really, really cool phone and spend their time on it than driving around. And if you wanted to get a date, it used to be that you had to have a car to go to a drive-in. Now, of course, you just go on Tinder. You don't need the car, I'm told. China. China is very committed to clean energy, and you've probably been following the agreement, the China-US agreement, where China has agreed to cap its carbon emissions by 2030. One of the main drivers, climate is a driver, but one of the main drivers is this. Urban pollution. The World Health Organization guideline, 25 micrograms per cubic meter of the very small particulates. This is Beijing's world record. It's a world record that I'm sure they would rather not have. And their pollution problem is clearly so substantial that it threatens social stability. There's a very substantial level of unease and even protest against these sorts of levels of pollution. And one of the ways that they're going to deal with it is, it's clearly this sort of thing is driven by cars, and it's driven by coal close to cities. So you can move coal away. That was the sort of the British solution, although we also then had a gas bonanza. But clean energy is seen as a mainstream part of the solution to this. Li Keqiang, we will resolutely declare war against pollution as we declared war against poverty. The problem is recognized at the very highest levels. And when we model the future of China's energy mix, we did this before the before the China-US agreement recently. Here you can see what's happened historically. I'm sure you've all heard the trope that China is building one coal-fired power station a week, so why should we bother doing anything in the West? Well, that was actually back then. If you like, if that is one a week, what you can see is that China has already reduced the number of coal-fired power stations being built every week. We're now only at one every 2 weeks. It's not good, but it's better. And very interesting to note that 2/3 of new capacity built last year in China was actually renewable. And if you look out here in 2013, this stuff here, that's nuclear is orange. You've got hydro, wind, solar, biomass, and waste. Now, of course, renewable energy, the capacity, you have to multiply by a capacity factor. That renewable capacity only works 25% of the time, and the dirty stuff works 60, 70, 80% of the time, or maybe even more. So the actual contribution to China's energy mix is still heavily skewed towards dirty energy or conventional energy. Nevertheless, the trend is very clearly in favor of cleaner energy. If we model it out, this is what we see. By 2020, we're down to a quarter, not a half, but a quarter of a power station per week, one a month, not one a week. And by 2030, we anticipated that China would be net dismantling its coal-fired capacity. Net dismantling coal-fired capacity. And that's before the recent deal, which it was very interesting because in a way, in terms of peak carbon output, of course, when you start dismantling coal, then you're going to get peak carbon. What was really interesting from China's point of view was the commitment to 20% renewable energy. Over and above simply peaking and saying we'll figure out how, a commitment to 20% renewable energy. To put it in perspective, to do that, China has to build as much renewable energy capacity as the entire capacity of the US grid in the next 16 years. That's how much renewable energy they have to build to meet that commitment. So China is not, according to our sort of business as usual in a sense, this is our central scenario before the deal, that would not have got them there. And on the US side, the deal goes beyond business as usual. So if you look at the US is shifting to gas, it's going to use this gas bonanza in its power generation, and it's going to become more energy efficient. The EPA regulations that have been published are going to force coal out of the system in state by state. There's a plan. But even that EPA plan, which is politically controversial and being resisted heavily by the newly Republican Congress, even that would not reach the commitments that have been made in the US-China pact. So that pact is meaningful. It's not just saying, here's business as usual, this is what we're doing anyway, so we might as well put it on the table in the bilateral or possibly even at the UN COP discussions in Paris next year. It's a meaningful commitment. Germany. Germany is really at the heart of this kind of Europe boom-bust. Not so much because it's become impossible to invest in Germany. It's certainly a very robust economy and not a dangerous place to invest, but they are just saturating their rooftops. They've got a lot of renewable energy on the system. They've spent cumulatively $166 billion on this renewable energy, but of course, because it's of the feed-in tariffs, they'll actually end up paying a lot more than the 166 billion. And this is quite a big number even for Germany. And you can see how it peaks and it drops away. What they've achieved with that is to have shifted the mix so that you can really see their renewable energy in the, I'm not sure if I've got the, let me see. Yeah, there we go. 28% of German electricity in the first half of this year was renewable, 28%. And this is not a Mickey Mouse economy. This is Europe's largest economy, which is now 30% of the electricity. I think this last couple of quarters, it's going to be about 31% is renewable. So this is a considerable transformation. You'll have heard of it called the Energiewende, the big change, the transformation in energy. Just one thing that's worth noticing, what is the nature of that change? This is, again, using our big model looking forwards and also historic. This is the German energy mix. There you've got fossil underneath, nuclear and renewables growing there on top. And the interesting thing to note is that so far, the Energiewende has been nothing to do with climate. It's all about enabling the shutdown from nuclear. To me, this is an extraordinary, inexplicable thing. Why, when you have functioning, low-carbon, baseload, dispatchable nuclear, why you would preferentially shut it down before you shut down your coal. Now, the Germans will have thought, because of the EU ETS, the carbon price, that fossil should be transitioning from coal to gas. And so in a sense, the climate piece of their policy would be met by that. But of course, what's actually happened is the EU ETS price, which is now about €6 or so, is so low that it has not shifted from coal to gas. In fact, those who bet that it would built beautiful new, highly efficient gas-fired power stations, some of which opened as recently as 2011 and are mothballed and may even be shut altogether. And the volume of coal that Germany is burning has been increasing and not decreasing. Now, of course, going forwards, that's going to change, and the Energiewende is going to end up by reducing fossil. In fact, the break point in the series is around now, so it's a little bit unfair to be too harsh on Germany. But let's be absolutely clear that German energy policy has prioritized nuclear shutdown over climate, and I think it's always, well, whether it's worth pointing this out whenever the Energiewende comes up, I don't know, but it's certainly fun to point it out because you get quite an interesting reaction. When I started to look at renewable energy, clean energy, I always thought it would go like this. This is mobile and landline telephony. I thought that, you start off, mobile telephony was expensive. You go back to 1993. And it also offered an extra benefit of being mobile. So it was like a landline, but it was mobile, and you paid a premium. There were certain segments, I think it was initially plumbers and workmen who needed mobile because they could then secure their next job whilst on the road, and that was worth money, and they'd pay for it. But as more and more people go mobile, eventually it gets to the point, and it took, there you can see 14 years, where mobile is the same cost as landline. I don't have a landline anymore because the only reason I used to keep it 5 or 10 years ago was because it was much cheaper. Now it's simply less convenient and the same price, so I don't have one. I'm done. And I thought the same thing would happen with renewable energy, that renewable energy is like, or renewable electricity, it's like normal electricity with the added bonus of being clean. So those people who want will pay a premium, others won't. But based on the people who pay the premium, you go down the experience curve and you see the two prices converging. And I thought, I think I first postulated this in 2007, and I was jolly pleased because by 2012, the two lines had converged, and I thought, well, that was very quick. That was much quicker than we had expected. I must be even cleverer than I thought. The problem was that actually that's what happened. There's something different going on, and that is because wind and solar, particularly geothermal as well, renewable energy tends to have no variable cost, very low maintenance costs, low variable costs, and whether or not it's subsidized, if it's just preferred, in other words, if the utilities are told you have to take this stuff first, then it wreaks havoc with pricing in a way that mobile telephony doesn't. With mobile telephony has a variable cost that's very similar to fixed line, but what you've got here is a competition between an energy source with no variable cost against gas and coal, and even nuclear, that do have variable costs. And what it does is it messes up the entire pricing structure in the industry. So you see there that this is the residential power price here in Germany. It goes up, and the feed-in tariff goes down. And of course, what's likely to happen here is a flip, because now, if you're, if you're being charged 30 euro cents per kilowatt hour, but that is the price at which lots of solar is available, then you'll do that. Actually, hang on a second, is that right? Because the feed-in tariff doesn't quite work like that, does it? Dun, dun, dun. Yeah, I think you have to translate. It's not. That's just that's the feed-in tariff which you're paid for production. But nevertheless, what you can see there is that there's a very real problem of pricing, which has hit it's hit the profits of the German utilities very substantially. What they're essentially doing is finding their large-scale generation unprofitable, because during the day, when they used to sell power at the most attractive time of day, what they're now finding is very often the power price going negative. So let me just give a couple of other sectors that I want to talk about, which would be energy efficiency in cars, energy efficiency, LED light bulbs. I don't know what the proportion is of electricity which is used for lighting, but I think it's something around 20% in developed economies, because we tend not to use electricity for space heating, and so electricity is essentially appliances and lighting, and LEDs are 90% more efficient. So this is absolutely, this is a large-scale impact on electricity demand. And this is great. This is the bit where we get to laugh at Australia, where I'm going in a few days. I'll probably have to pull these slides when I do. But this is there's GDP and historical electricity demand as experienced by the Australian national grid. And back in 2010, the national grid had a forecast for demand, which was that. Now, the reason I put GDP there is because it was a very simple life being an electricity demand forecaster, because you took somebody else's estimate for GDP, and then you essentially translated that into electricity, and you added a bit, because electricity tends to grow a bit faster than GDP. But it was a relatively easy life. The only problem was 6 months after producing that forecast, that was the outturn. And it's partly solar on the roofs, which means that the electricity doesn't get seen by the grid, and it was partly energy efficiency. So they produced another forecast, obviously reset the ratio and blah, 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 and then run the same spreadsheet, and they come up with that. And you know where this is going. That was the outturn very soon afterwards, and so there was another forecast. And I like this one, because this one says, hang on a second, I need a year to find a new job. That was the outturn, and that was the 2013 forecast. I need this updated for there is now a 2014 forecast. I expect the 2014 forecast to be much, much more accurate, because surprisingly enough, after this period, they became Bloomberg New Energy Finance clients. But what's happening here is a decoupling. I like Australia as an example because they didn't have a recession. Some other countries, you can plot this, but there's a recession and it gets a bit harder to see the signal. What we're seeing is a decoupling between economic growth and energy and electricity demand. And it's clearly significant because it has wrong-footed the biggest experts. And if you look at the difference between the 2010 and 2013, you're looking at a 10% decoupling, 10% demand reduction below what you would have expected for the commensurate level of economic activity. Let's talk about cars. The Tesla, fabulous car. I've sat in one. I haven't driven it. It was in a showroom, but I got to sit behind the wheel. I was going to say I was going to sit behind the wheel and go brum, brum, but of course it doesn't do that. It just goes wee. But it is a fabulous car. It's the car of the year in endless magazines. It's the safest car, and so on. And it's a game changer. There's just no question. But it's very important to remember it's an extremely large game. The game here is 85 million light vehicles, cars and light vehicles globally, growing at about 4% per annum, largely driven by the middle class growth in the developing world, China and India and Malaysia and so on. And this is the number of hybrids. I apologize, the colors are wrong. That's the number of hybrids, and that is the number of electric vehicles. So very, very small actual numbers of electric vehicles. That's not just Teslas, but it's all the pure electric vehicles. So it's very, very small numbers. And again, it's hard to say that the transport industry should be quaking, car companies or oil companies should be quaking in their boots at these very, very small numbers. However, I think it has already had disproportionate impact, because I think that this is one of the reasons why cars are so much more fuel efficient. Of course, there are changes in the standards, but car manufacturers have essentially not competed on efficiency. They've competed on features, cup holders and better radios and those sorts of things. And now suddenly they think, hang on a second, electric vehicles, they work, they're cool, they accelerate really fast, they're quiet, they're comfortable, you don't have to go to a gas station. Why is this not just a better solution? The only problem, there's two problems with them. One is range, because if you run out of juice, it's not clear where you get it recharged or how long that's going to take. But if you're a commuter, and I just met somebody yesterday who has had an electric vehicle for a commute for 3 years. He says it's unbelievable. He saves $400 a month on a 50-kilometer commute. He cannot imagine going back to a non-electric vehicle. So they've responded by making cars more efficient, smaller engines, to the point where, you know, Formula One now is being run with 1.6 litre engines. They're double turbocharged and they're tremendously powerful, but a 1.6 litre engine, I mean, this is a sewing machine. In fact, the funny thing is, Formula One now sounds like a bunch of sewing machines. So I think this is a tipping point, because the next generation's Jeremy Clarkson is not going to be very impressed with that. And actually, I think I've got a bet. I put it out on Twitter. I haven't had Jeremy Clarkson yet take me up on it, but I think that the lap record at the Isle of Man TT, the motorbike race, is going to be held by an electric bike by 2020, because the performance is so fabulous. And I think the Hockenheim record for the car will be held by an electric car by 2025. And that's because the performance of these cars, these vehicles, is so incredible. Of course, these are one-lap records, whereas, you know, so these are not enduring. I think it'll be a long time before an electric vehicle can beat conventional in the Le Mans 24-hour race, but that's a longer-term challenge. But the other problem for electric vehicles, other than concerns about range, which I think are largely non-issues, the other problem is price. And there again, you've got an experience curve. Here you've got lithium-ion batteries. The bottom ones are cheap ones for your phone. The top ones are ones that are not supposed to burst into flames because they're for your car. So they're a bit more expensive currently. But you can see there that they've been coming down these experience curves. And it is just a fact that all of these clean energy technologies come down experience curves and are not affected by resource curves, so they don't have depletion curves. Even rare earths, I don't believe, are particularly rare. As we need more of them, so more will be found in a broader range of countries. And so we see these experience curves working in batteries. There's no limit on the amount of lithium. And that is the impact of Tesla's gigafactory. So Elon Musk has announced this vast factory in Nevada, $5 billion investment, working with Panasonic. They know a thing or two about batteries. He knows a thing or two about innovation and breaking the mold. And that's what Tesla's gigafactory will do. By 2020, it will have driven the costs down to there, exactly as you'd expect on the experience curve. And the green horizontal band is where electric vehicles, on a total cost of ownership, become cost competitive for most users with internal combustion engines. So those people who count the pennies, which includes most families and all fleet operators, will actually find electric vehicles by 2020 comparable or cheaper than conventional. And if you add to that the impact of air quality, which is a problem not just in Beijing, not just in Delhi, but also in London, I can't see how this is not going to drive a wave of electrification of transport. So we are already seeing, now we're back to the flows of money. You saw that for the last 2 years they've been going down. This is the quarterly picture. You can see now they've turned some sort of a corner and they're at least drifting up. It's not a decisive move yet, but it does look rather as though a corner has been turned. In terms of the gigawatts build, you've seen this, that the gigawatts went down for the first time last year. But we track new build projects that have been approved. We track financing, that's what one of the things my big team does, and we know that it will bounce back because we know that financings have been closed. And so we forecast energy mix and energy demand and so on out into the future, but we also, in the near term, just tot up how many investors we know about closing deals, and so our near-term forecasts are very much driven by that, and that's something like a 37% increase in the next couple of years in gigawatts being added to the world's system. So my thesis of a turning point here looks more and more solid, I hope. And then in the longer term, this is the addition of gigawatts capacity in the electrical system, 2015, 20, 25, and 30. And you can see that we think coal is essentially going to be squeezed out. Gas will remain there, but it's not going to grow very substantially. And then on the other side, you have renewables. Now, it looks very dramatic because, of course, renewables, again, it's the capacity factor. If you look at output, you'd have to divide it by 2 or 3 to be comparable. Probably you'd divide this by 4 and divide that, take a third off that to be comparable. But you can see that the bulk of capacity being added to the world's electrical system is going to be renewable going forwards. And if you think this is a kind of an extreme position by a bunch of analysts, it's Bloomberg New Energy Finance, so it's an extreme position, I can tell you it's not that far different from the new policies environment, new policies scenario produced by the IEA. It is simply the economics of falling costs of clean energy and not so fast, potentially even increasing costs of conventional. Let me just talk about a couple of other things. I mean, this is not being driven. I haven't mentioned anything about corporate social responsibility or any of the other movements that are going on. The carbon budget. I don't think I've used the word climate yet, so I suppose I ought to. Fossil-free movement is really interesting. I think it's very significant. I think it's very dangerous to compare it to apartheid, by the way, because we didn't have an apartheid budget. Right? There's no acceptable level of apartheid, in the same way that there's no acceptable level of paedophilia or all sorts of absolute bads. But the fact is that we do have some level of acceptable carbon emissions. And so the nature of the solution can't be demonization for a resource that we need to use and indeed to a certain extent can use. It's just that there is a qualitative difference between that and something that we simply can demonize and call bad, where there are no mitigating circumstances. The other problem with divestment is, if you look at that's the total size of divested portfolios as of September is 50 billion. Yes, there's been university endowments and some Scandinavian pension funds, and it's pretty exciting whenever there's an announcement. That's the total size of the divested portfolios, 50 billion. Their holdings in fossil fuels were probably 5% of that. So it's probably only a couple of, 2, 3 billion. The headline figure of $1 billion fund divest actually changes only a few tens of millions of dollars of what they actually hold. And that is the size of the quoted oil and gas companies. It's 5,000 billion. So you've got 50 billion, of which probably only a couple of billion is truly divested, against 5,000 billion of market value. And if you tried to take money out of that 5 trillion, and put it into clean energy, the entire free float of all of the NEX index constituents is only 350 billion. So you'd be trying to take something out of the big bubble at the bottom and squeeze it into the little bubble at the top. And that is, although of course some players could do it, it's clearly not a sort of macro solution to the problem, at least not in the near and also not in the medium term. The other problem you've got is that oil companies are extremely good investments. Right? They are high-yielding investments. So for a pension fund, for an insurance company, they tend to provide about 2.5%. The companies in this 5 trillion have been providing 2.5% dividend yield over the long term. And if you look around for industry, say, okay, well, we can't put it all into clean energy, let's put it into other things. The only industry, the only sector that's the same size as oil and gas, coal is much smaller, it's a different thing. The only industry is actually IT and information technology and telecoms, which is of a similar size, but it yields 1%. And the reason is it's fast growing and it tends to have companies in it that are not yet mature enough to pay dividends at all. And so what those pension funds and insurance companies will be looking at is, how do they pay pensions? They're looking for high-yielding investments, and they're not finding any. And if you look at food or pharmaceuticals, again, you could divest, you could put some money into those areas, but they are smaller sectors. What we are seeing that's very exciting, though, is financial innovation. Actually, before I do that, let me say why I do think that divestment is interesting. And the reason I think it's interesting is it creates room for innovation in the financial system, because if you worry as an asset manager that somebody is about to rock up, one of your big endowments whose money you manage, and is going to ask for a portfolio that doesn't include coal or oil companies, then the best response in the finest capitalist tradition, well, the first response is probably to try to dissuade them, but the second response is to say, well, why don't we innovate? Why don't we make a product that doesn't have coal or oil in it, and we'll market it, we'll be proactive. So not only our clients might have that option, but why don't we go and steal somebody else's clients by saying we can do this, here's a product. And so you do see this around the world. You talk to asset managers, and they are starting to investigate. What would it mean? Would it mean we'd have to earn lower returns? How do we provide the same yield, et cetera, et cetera? And of course, out of that comes new products. And so I think that that's a very important dynamic. I think possibly more important than the moral questions or the pressure, the activists camped outside your meetings and so on. The final point on this, before I move on to innovation, is coal is a much smaller, it's much easier to get out of coal than it is to get out of oil and gas. Just visually, you can see coal is about 250 billion market cap. The number of people directly employed in coal is enormously lower than people think and than it was 20 years ago around the world. And so coal is a much softer target. Financial innovation, we're seeing this now. We used to see some financial innovation in 2005, 6, 7 when everybody was excited about this, when Leonardo DiCaprio was all, was on the cover of magazines talking about, solar power at his ranch and all that sort of stuff. And then it went dead. There was no innovation because the financial sector went into an incredibly risk-averse period with the collapse of Lehman, people willing to take risks, people willing to take career risks. Essentially, we didn't see innovation for quite a few years. We start to see that now coming back. We see new owners coming in. We see people inventing new mechanisms. There are investors that want the yield, but they're not allowed to buy a wind farm. So you see something called a yield co. The yield co buys a bunch of wind farms. It's quoted, so new investors can come in who are only allowed to invest in quoted stocks. So you give them an option to do that. We see peer-to-peer solutions. We see these solar rooftop companies, instead of just borrowing money from big financial institutions, we see solar bonds being floated directly to savers. We see new solutions around foreign exchange risk management, ESCOs, energy service companies, the prepaid solar in the developing world. There's M-Copa and a company called Azuri, who are making really good headway with prepaid solar models, blended finance coming out of the international monetary system, or the World Bank, the Asia Development Bank, the Africa Development Bank. They're getting much cleverer about saying, well, for this bit of project development, we have to give a grant, but for this bit, we can give equity, and for this bit, we can give debt. And putting it together where, in such a way that something happens where if you just give the grant, nobody finances, and if you just give the equity, there's no debt, and if you just, so they're putting it together in a clever way. And then, very interestingly, green bonds. I think I've got a chart on that, so I'll come back to that. So new owners, you see people like Warren Buffett started in 2011 at the recent Berkshire Hathaway annual meeting. He said we've poured billions and billions and billions of dollars into renewables, at which point one of his bag carriers came forward, sidled up and whispered something into his ear, and he said 16 billion apparently. So that's a lot of money, and we're going to keep doing that as far as the eye can see. He's confirmed he'd be happy to spend another 16 billion investing, not in renewable energy technology companies, although he owns a big chunk of a Chinese electric car company called BYD, a battery company. But he's buying projects. He's buying solar, he's buying wind, it's high yielding, it's better yield than sovereign debt, and the risks are acceptable, and so he's buying lots of it. Green bonds, I said I'd come back to. This is a market that we have expected to take off, we've hoped would take off for the better part of a decade, and it hasn't. You see here these very low levels during the risky periods. This is a little bit of probably World Bank debt, and then you see it takes off. 2014, it says here we think that we'll finish the year on 39.4 billion. I actually think it'll be north of 40 billion, could be 45 billion. And what this is people raising money to invest in climate, clean energy solutions. There's various ways of doing it. You can invest first, then you can bundle it up and you can float a green bond, you can refinance. You can say, I happen to have 5 wind farms. How about we now raise a bond and I can then take that money and recycle it? It could be new investment. A lot of it has been in the past through the international financial institutions, the multilaterals. But what we're now seeing is corporates doing this. We've seen Bank of America, we've seen some of the utilities, and this sector is really taking off. And the hope is that it lowers the cost of capital for green solutions over brown or conventional, whatever you want to call them. If there's enough demand from investors who would like to see the balance shifting away from fossil fuels, coal, oil, gas, and they want to see more renewable energy, more clean energy, more energy efficiency, more public transport, more water treatment that's resilient to climate change and so on, then you need a very deep pool of cheap debt. And I think green bonds is at a sufficient scale to offer some promise. Let me talk about climate scope. This is something we do because, again, of the interesting things we see going forwards, we were commissioned initially by the Inter-Americas Development Bank to do Latin America, but then we've got these new nations here that we've added this year. This is the 3rd year that we've done the study. We got funded by DFID here in the UK, thank you DFID, and USAID to look at how attractive are countries for clean energy investment, which ones can expect money to flow and which ones really need to sort out some part of either their energy policy or their climate policy or their capital markets. Are they welcoming or not? And I actually think I've not got the slide that shows the results, but China is best, Brazil is second, some very interesting countries up in the top 10, even some smaller ones. Nicaragua is a good location, not because it's so big, but because it's just got itself sorted out and is a good destination for investment. But the interesting thing I wanted to show you is this. This is power capacity growth. On the left, you've got cumulative capacity in gigawatts, but on the right, you've got percent. And the line, look at the lines. The top line shows capacity growth in the countries we studied, which are broadly speaking 55 big developing world countries, and the blue line at the bottom is capacity growth in the OECD. Now, immediately you look at this and you think, hang on a second, basically new capacity is being built outside the OECD. Maybe that's not so exciting and new, but I thought it was a nice way of showing it. But here you look at clean energy capacity, right? Same chart, but now we're talking about renewables. And what you see is that renewables is not a rich country folly. The growth rate of renewables is higher in the climate scope countries than it is in the OECD. Right? And this mirrors what we've been seeing for some time, which is that renewable energy used to happen in Europe and in North America, and pretty much that was it. And then we saw China, and then we saw India, and we see Morocco, and we see South Africa, and we see Mexico, and we see Chile, and so on. And so these technologies are being taken up more and more around the world in country after country. One of the reasons why that is a lot of these countries have very high electricity costs. You know, we don't generate electricity from fuel oil or diesel anymore in the developed world, very, very low levels, but they do in a lot of these countries. And so what you see is the onshore wind levelized cost down here is cheaper than the electricity price in all of these countries. Right? And then solar is cheaper than these countries. And you can say, oh yeah, but it's intermittent, and you know, really the world has a responsibility to provide the same quality of power, 5 sigma, 5 sigma, 6 sigma reliability. You know what? If you've got no power, you're quite happy to have some power. And by the way, I mean, I should, even before I say that, most of the more sophisticated countries have got grids that can accommodate some pretty substantial level of renewable energy. You know, we used to hear that, well, you can do 3% wind, but anything more than that, you make the grid fall over. And then, of course, Germany got to 3% very quickly, and Denmark, and, well, but you can't do 5 or 7% would really be the limit. And then the limit was 10. You know, we are up to 31%. And so these countries can accommodate the more advanced. Mexico has fantastic, you know, Chile, they have fantastic technical capabilities. And then even the very poor ones, it's better to get some power than no power, so you can run your refrigerators some large part of the day and so on. And then there's distributed. This is an example from Kenya where people are using kerosene. Kerosene is filthy. It's bad for climate, but they're not using very much of it. But it is also unhealthy to burn kerosene in a closed space. And it's expensive, $4 a week to light a home with a few rooms. Solar, the equivalent, $1 per week. Now, the problem with solar, of course, is you have to pay all the money up front. You have to buy your solar system. And this is where prepaid is very interesting, because, of course, that enables you to pay solar in the same way as kerosene, but at a lower price point. And this is taking off with extreme rapidity across the developing world. And you mentioned that I was on Sustainable Energy for All, and there's 1.2 billion people who don't have access to electricity. I think when we started, when I first got involved, it was 1.4 billion. We will solve that problem. But when I say we, I don't mean we, I mean the people themselves, because you know, this is so much of a better solution than that. And I think the challenge that we really need to start working on now, proactively, rather than wait until it's a big issue, is how do you move a family that, okay, so they need a solar lantern so that the kids can do their homework, and so they need solar power so you can charge up the mobile phone, of course, because everybody, 70% of people in the developing world have phones. So you do all of that. How do you make sure that system can grow so that you can then add more than just the light? So you want to be able to add a fan, you want to add a radio, you want to add a fridge, you want to add a television, you want to add a sewing machine, so then you can be economically active, you want to add a drill or a metal bashing equipment and so on. How do you make sure that these distributed solutions are forward compatible? I think is a really interesting and big problem. And in the developing world, what we're also seeing is that country after country is sorting out its energy policy structure with a lot of help from World Bank and IRENA and various other players, but they are actually they're reforming their energy system to become attractive to clean energy. Now, these changes that we're talking about, this kind of step change, by the way, I just point out, is also happening, it's not happening because of divestment, it's happening because of economics, it's happening because of innovation, it's happening around the world, including the developing world, and it is happening despite a heavily tilted playing field. Fossil fuels, IEA figures, 544 billion of consumer subsidies. So those are countries where they say oil should cost, or a gallon of gasoline should cost you this, but we're only going to charge you that. And the delta is 544 billion. But that does not include producer subsidies. It doesn't cover the defense subsidies. It doesn't cover the impacts on health. It doesn't cover the corrosive impact of volatility, being exposed to commodity market volatility on the economy, and it doesn't cover the big externality of climate. And the level of clean energy subsidies, I've got a better figure than that, it's 120 billion. So we're still talking about I don't know, if you add all of this up, we're probably talking 10 to 1, the externalities and subsidies that play to the favor of fossil fuels over clean energy. So the fact that clean energy has got to where it has got is actually pretty extraordinary and a testament to the value of the solution. So hopefully I managed to persuade you that this is actually what we're saying, that there is a phase change. It's not just volume of electricity, it's not just these are fundamental changes to the structure. We saw the German example about prices. This again from Germany, this is the demand profile, sorry, the supply profile in 2012. Sadly, I've lost the key on this one, but here you can see this is wind in blue, nuclear, I think that's probably coal gas, that'll be coal there, and then you get solar in yellow and various other, there's biomass and a few bits and pieces. And what happens to that if you take the same weather and you put it through what we think the system will look like in, that's 2033, you can see much more solar, you can see much more wind, but you also see things like they have to be dumping electricity on their neighbors in large volume when they overproduce. Because the opposite, the flip side of the capacity factor of renewables, that it only produces 25% of nameplate, you therefore have to overbuild, but of course every so often it produces nameplate, and so then you have to sort of have a good relations with your neighboring countries because you never know when you need to use them as a battery. And so the entire structure of demand, your relations with your neighbors, the interconnects, everything is going to change. And the other, looking forwards, this is not a small thing. All of this progress has been achieved with very high cost renewables historically, and the cost reductions have not yet fully flowed through. So this is in America. What you've got here is this is the German price for a rooftop system, and that's a California price. The fact is that the Americans are currently still paying over 100% premium for solar rooftop systems over Germany. I mean, name one other manufactured good which is more expensive in America than in Germany. I can't think of one. So clearly that delta is going to collapse, and it's driven by lots of things. Basically it's driven by immaturity of the industry, lack of competition, and overly bureaucratic permitting systems. It will go away. American people will not put up with that sort of a delta. The market will speak, and it is speaking. I think we're going to see that coming right down. And in terms of technology, looking at the sort of, again, the near future, how does this play out? I'm not going to go through this because I know that you're all a bit panicky because you're all economists and geographers and policy and whatever, but if there's any engineers there are some fabulous examples of technologies which allow and enable and accelerate this kind of structural change towards effectively more renewables and more distributed solutions. What you've got is renewables, because they're intermittent, you have to run backup, and there's a climate penalty to running the sorts of kit that provides backup tends to be less efficient, and it has a higher carbon footprint and a higher cost. Well, guess what? GE is not stupid, and the big gas, Alstom, and the big gas turbine providers, and so they are producing technology now which can peak very quickly. You can run it at very low levels of load and then suddenly slam the load on without its emissions going up, without losing efficiency and so on. So another technology, the hybrid, high voltage DC circuit breaker. Renewable energy is not in the place where we used to generate power, and it's in Inner Mongolia, and it's in the North Sea, and it's all over the place. And so we need to bring that to the sources of demand using high voltage DC cables. There's been a 100-year-old problem that it's very difficult to switch high voltage DC on and off. You get huge spikes and you tend to blow things up if they're connected. So there's a technology there that ABB has produced that can solve that problem. USB 3.1 is a fabulous technology. This is your USB right now. It can just about charge your phone. The next version of it could run a 100-watt electrical light if you were still able to buy one. Or you could run, so the next time you have if you build a new house, or the next time you really do up the electrics in your house, you'll just have USB sockets instead of 3-point plugs, because all you're going to be doing with it is charging phone, running your laptop, and running an LED light bulb, which anyway prefers low voltage to 240 volts. And then I like this one because I've got one in my, what used to be a coal cellar. I now have a fuel cell, which is distributed CHP. It's 85% efficient compared to about 45–50% efficiency of centralized electricity generation. and no line losses, and I use the heat. The reason it's so efficient, it's 60% electrical efficient, and I use the heat for my underfloor heating. And so I can now do for myself what before only a utility could have done for me. So the structure is going to change. And I think I'll finish with this example of another industry that underwent structural change to the nature of its markets. And this is the US newspaper industry, advertising revenue over the last 60 years. And what you can see is, at this point here, the invention of the internet. And very few newspaper executives will have even noticed it. Maybe it was a science story, but probably not even that. And then here, you have the invention of the browser, Tim Berners-Lee, brilliant invention of the browser. And then there were some cool people that noticed it and maybe started to talk about the future of news and the future of this and that, and largely got ignored and certainly didn't get as far as the boardroom of any newspaper. The invention of the smartphone, and at that point there, McKinsey will have started to say that at some point somebody might read a news story on this thing, and you might want to think about that. So it was probably there was some presentation. In fact, I left McKinsey in 1995, and they were starting to have those discussions, but nobody in the newspaper industry really thought that this was in any way an existential threat. And that is, I call it the founding of Twitter, but it's really the advent of social media. And quite clearly, that triggered a very dramatic, very rapid destruction of the economics of the newspaper industry. And the same sort of thing, structurally, if you are a newspaper buyer and some people stop reading the newspaper, and therefore the same amount of costs now have to be spread over fewer readers, and the newspaper goes up from £1 to £1.50, and then some more people say, do you know what, I don't really need this every day, and then it becomes £2, and a few more leave it, and eventually newspapers become £2.50 and £3 and £4, and this is known as a spiral of death. So I'm not saying this is what is going to happen to the average utility, but there is a very similar dynamic potentially at work, whereby distributed energy is to utility as social media is to newspaper. And utilities, when I first started to talk to them about this in 2007, they laughed nervously. They didn't laugh, they laughed nervously at me because I was saying something so stupid. I went to California and asked them what they would do when their daytime electricity price dropped to zero because of solar on people's roofs, and it was, well, we don't think that's going to happen, so you don't need to answer the question. And of course now it is absolutely what is being discussed in the boardrooms of pretty much every major utility, is how to deal with this change in the structure, not just the volume, but the structure of their markets. Thank you very much.
Huge amounts of information, lots of questions raised in my mind. Anyway, unfortunately, we're nearly out of time.
Oh, no.
So we've got time, I think, for 3 questions. I think Michael's going to stick around for a bit before dashing off to get some rest before flying to Beijing tomorrow. So 3 questions, and then you can call it over a glass of coffee. One there, Peter.
Michael, that was a great presentation. Thank you very much. Don, how resilient is your sort of look forward to the sort of pushback that we should expect to see from big utilities, and to some extent they will tell policymakers to change the policy context in their favour, will they not? They'll talk about grid resilience, and the fossil fuel guys, they're going to be able to sell it cheap. I mean, we're seeing that now. So supposing fossil fuel prices come down and stay down for some time, is this going to mess up the plan? And secondly, if, for instance, the prioritisation of renewable dispatching on the grid, which are ever being changed, would that be another thing that might set us back a long way?
So the answer is I don't think this is going to be quick or painless. And the famous quote, which is attributed to Gandhi, although actually I'm not sure that he came up with it first, first they ignore you, then they laugh at you, then they fight you, then you win. I think that what you're talking about is the then they fight you piece. And clearly, if you're a utility, you have a decision to make. If you believe this story, then you can do one of two things. You can either restructure yourself to play this. So, for instance, instead of selling bulk electricity, you say, what we're going to do is reach out to the end user and help them manage assets, help them buy, help them sell their excess clean energy, help them buy a portfolio of energy which meets their needs, do the balancing, provide the grid stability, voltage regulation, all these other services. They can either do that and probably quietly divest of a bunch of generating assets, but their other strategy is regulatory capture, which you described. And you see a range of responses. I think definitely, as I say, in 2007 when I went to California, it was a combination of ignoring and laughing, and now it's a combination of some fight and some restructuring. So if you look at what RWE is doing in Germany, they have essentially failed. Regulatory capture has failed, and they've realized that even with the problems of the energy vendor, that Germany is going to continue on that route, and therefore they're starting to strategically reevaluate and come up with what are the services that the modern, that the householder who goes down this route, what services does that person need, and let's offer it. And I think that's a really healthy response. Will others? I mean, you've got another embedded in there is another question about, wouldn't it be easier if fossil fuels were more expensive, because then it sort of pushes people more quickly. Success, in a sense, or the end point of this is not a $300 oil price, right? Success is a $10 oil price. That's when you know that this stuff has worked, and that people are simply not buying the oil because they have got better solutions. Either they're, to a certain extent, not allowed to because it has all these externality costs that we don't want, or because there are just better solutions. I don't know whether it's $10 or $20 or $30, but break-evens for country. This is incredibly threatening, by the way, to countries whose oil break-even price for their national budgets is $90, $100, $80, $90, $100 per barrel. So it's not going to be. You can imagine it's not going to be a smooth transition by any means. But equally, it's the underlying economics. Who can fight it? Ultimately, I have no doubt this is the direction we're going. I do have doubt as to whether it will take 20 years or 50 or 60 or 70 years.
Thank you very much. My question fits in with the last one in a way. I sense a slight ambivalence in your own mind about the role of people. Your last slide of the social media and your comments at the beginning about decentralisation felt exactly right to me, and a lot of it is being driven by individuals and their own choices. But then you sort of blotted your copybook for me with what you said about the Germans and nuclear power, which I see as utterly a democratic response. So are you sure you're consistent, or is it just that the countries aren't consistent, or I'd just like a bit more about, because I think it's not going to be, I'm sure the big companies are going to fight very hard. I'm sure there's going to be regulatory problems, but it might just be we'll do it anyway, because you and I will.
I am a, first of all, let me be absolutely clear, I am a vast Democrat. So, those people who say we ought to be like China because China is transitioning its energy system more quickly than us, I think they're just, wrong on so many counts. I think that it's much more robust if we do it having gone through a democratic process, even if it involves listening to some rather unpleasant fantasists who, playing pretend energy policy as we have to do. I'm not going to name any current politicians, but the Germany thing, I guess, I have to do this without making a joke about whether Germany can, despite being democratic, can sometimes make some very bizarre and harmful choices. I don't see nuclear as the enemy. And I don't see it not just because I studied it and I like nuclear, but also if you look at the number of deaths caused by nuclear versus the number of deaths caused by coal, it is orders of magnitude in nuclear's favor. You know, the fact is, everybody says Fukushima. I think it is insulting to talk about Fukushima, but not to talk about, which has, so far, not one named individual has died because of the nuclear accident, but whatever it was, 20,000 people died because of the tsunami. And so, we're taking the wrong lessons. So what we've seen is, whether it's Windscale, 3 Mile Island, even Chernobyl, which did kill a large number of people, I think it's something like 5,000. The sort of the most rigorous analysis of the fatalities from Chernobyl, done by the UN, the World Health Organization, was 5,000. Tragic, but even if you divide it by the amount of electricity provided by nuclear over the last 50 years, 60 years, it is vastly safer than coal. So to focus on shutting down your nuclear, and if you look at the issues, proliferation, or what to do with waste storage, there's a big difference between suggesting a new country going into nuclear and maintaining nuclear assets. Shutting down Germany's nuclear doesn't solve their waste problem. Continuing it, using as long of the lifetime of those assets, does not add much to the waste problem. So it seems to me a wholly irrational. Now, it's democratic, and so I accept it, okay? But I allow myself to mock it, or to say that I think it's a colossal economic own goal. And look at Japan. Japan has got now, they were doing, I think it was 23 or 24% nuclear power. They shut it all down after the Fukushima accident, correctly, because it was clear that the regulatory process had failed. A completely, in a sense, expectable accident caused, or incident caused this, so it was clear that something had gone wrong. But they then went through those plant by plant. There are 10 or 12 plants that really ought to come back online. And what are they doing? They're importing coal and gas. And it's, to me, it's just, let's try, if you try to be rational about it, you would switch on at least half of those plants. And the fact that they don't is much more to do. These are, I don't want to say they're emotional reasons, and you're looking at me like this, and I can see from the body language that I'm not being persuasive. But the question is, if you're concerned about climate change, then you have to be consequent and look at the solutions that are at hand. If you don't like nuclear because some other reason, to be honest, I'm missing it. I'm not sure what is the big disadvantage of maintaining existing nuclear assets. I just don't see it.
So, final question. Maybe there.
A question about vehicles. You're suggesting that around 2020 it's conceivable that electric vehicles will start making sense for people. And that's going to make a lot of change for users and for companies. But we're also hearing that around the same time there's going to potentially be this move to driverless vehicles. And I'm wondering, do you see these as potentially synergistic, or are they going to be competing? That both the companies and the consumers are only going to be able to handle one kind of mega change in the kind of vehicles we use in this time period.
So, very interesting. A very interesting question, because what it really does, it sort of highlights the vehicle, the transport industry is also on the verge of some kind of a cusp. I think that the shift to driverless, my suspicion is it will be longer than 2020. And please don't quote me, this has nothing to do with anything I've heard at Transport for London. It's just speaking as an engineer, and also as somebody who, I'm just aware of risks. So driverless vehicles will be much safer than vehicles with drivers, but they won't be perfect. No system on earth is perfect. And if somebody really dashes out from a concealed location very fast under the wheels of a driverless car, they'll still manage to kill themselves. And the first time that happens to somebody's kid, you could imagine that the mayor of that, that town or whatever is going to face vast pressure to ban these things. Because you could, just imagine what the Daily Mail is going to say with the first time a driverless car is involved in. There was a story that did the rounds of the internet. There was Google has a driverless car. Google's driverless car had an accident in the Google car park. Ha ha ha. Well, actually, what happened is someone drove into it. And so you've got to take the kind of the human component of a shift to driverless, which I think we will be very cautious about. I see that shift as being slower than 5 years. But in a sense, your question was, will the two be complementary? They will be complementary because electric vehicles they're much, well, their control system is simpler. They're much simpler bits of kit. One of the interesting things is their maintenance costs are much lower. So they don't have gearboxes. They don't have engines that spew out various forms of toxic gases. They don't have vibrations the same way that internal combustion engines do. And they've got very simple electric motors which can be fully sealed. They don't bring in air from outside to burn. So you can seal their components. And they have just far fewer moving parts. They're just fantastic pieces of kit from that point of view. So the ability to turn them into a driverless car is much easier when a car is, it's fully electric, it's got a fully electric control system, it's already going to be connected to the internet, for instance, because I don't know if you followed, there was another story with the Tesla where one of them hit a piece of debris on the road and it burst into flames, which the people got out, nobody got killed, and by the way, that happens a lot to normal cars as well. But they were able to adjust the ride height of the cars in response to that over the internet. I mean, this is a different world. This is a completely, it plays a different, it's just structurally very different. So I think that the two moves and others around, in terms of having the always connected car, and one of the reasons we'll want to do driverless cars is because we actually want to use our phones, or we want to do media, and we want to be connected throughout. So there's lots of trends that are coming together, all of which I think are co-evolutionary. I think they're all supportive.